Most people invest without ever stopping to ask one basic question. What is this money supposed to do for me? They buy a fund, keep adding money, and assume everything will make sense later. But investing usually comes down to a very simple choice. Do you want to grow your money or live off your money? In this video, I'm breaking down what that choice really looks like over time. I'll show you how I compared several major Fidelity index funds, explain which one of them naturally lands in the middle between growth and income, and then compare it directly to SCHD, which is built specifically to produce income using the same $100,000 in both cases. Both approaches can turn $100,000 into a multi-million-dollar portfolio. Both can eventually pay an income above the average American salary. But in the end, I'll show you how one path can grow that $100,000 into roughly $6 million, while the other builds a portfolio that pays over $28,000 per month in dividend income. Before comparing anything to SCHD, I wanted to make sure I wasn't cherry-picking a Fidelity fund just because it was popular. Fidelity has several major index funds, and they don't all behave the same way. If the goal is to understand where income and growth actually meet, you have to filter them intentionally. So I looked at 5 well-known Fidelity index funds, not to rank them and not to crown a winner, but to understand what role each one plays and what kind of investor each one naturally fits. This step matters because skipping it often leads people to the wrong conclusions. Fidelity 500 Index Fund, FITLX, is the classic growth engine. It owns the biggest companies in the U.S., and its job is simple: track the market and grow over time. It does pay a dividend, but income clearly isn't the priority. Most of what you're hoping for here comes from price growth. Fidelity Zero Total Market Index Fund, FZROX, takes a different approach. Instead of focusing on large companies, it owns a little bit of everything. That broad exposure is powerful, but it also means income is more of a byproduct than a goal. You're owning the market, not designating a cash flow strategy. Fidelity Zero Large Cap Index Fund, FITLX, looks different on paper, but in practice it behaves very similarly to FITLX. Strong growth, modest income, and returns driven mostly by what the market does. Fidelity Nasdaq Composite Index Fund, FNCMX, turns growth up another notch. This is where innovation and price appreciation take center stage. But income here is almost an afterthought, and consistency can disappear when markets get rough. Then there's Fidelity U.S. Sustainability Index Fund, FITLX. This is where things change. FITLX still tracks the market, but it tilts towards companies that generate real cash, manage their businesses conservatively, and consistently return money to shareholders. The dividend yield is real, the dividend growth is meaningfully stronger, and price growth stays competitive. That combination matters. FITLX isn't trying to maximize income, and it isn't chasing pure growth either. It deliberately sits in the middle, and that's exactly why it makes sense to compare it to SCHD. But before putting those two side by side, it's important to understand what FITLX is actually built to do, not on paper, but in practice. FITLX doesn't really make sense until you stop thinking about labels and start thinking about behavior. Ignore the word sustainability for a moment, because what this fund is actually doing is pretty simple. The fund becomes much clearer when you look at what it actually owns. This isn't a high-yield fund, and it isn't a speculative growth fund either. It's built around large, profitable companies that generate real cash and still have room to grow. Start with the sector exposure. Nearly 40% of the portfolio is in technology, with another 11.7% in communication services and 11.2% in financials. Those are growth-oriented sectors, and they explain why FITLX has been able to deliver strong price appreciation over time. But this isn't growth at any cost. You also see meaningful exposure to healthcare, consumer cyclical, and industrials, which adds balance and durability. Now look at the companies themselves. The top holdings include Microsoft, Alphabet, Nvidia, Visa, MasterCard, Eli Lilly, and Tesla. These are businesses with strong margins, pricing power, and consistent free cash flow. They're not dependent on cheap money or perfect market conditions to survive. They make money first, then decide how to allocate it. That shows up directly in the dividend behavior. FITLX's current dividend yield is modest, around 1.1%, which tells you income isn't the upfront focus. But the dividend growth rate, at roughly 15% annually, reflects the type of companies inside the fund. These are businesses that can increase payouts because their cash flow is expanding, not because they're stretching to meet a yield target. At the same time, growth isn't sacrificed. With average annual share price appreciation north of 13% since inception, FITLX keeps pace with the broader market. That's the key point. You're not giving up growth just to get some income. Growth still drives most of the return while dividends compound in the background. This structure creates flexibility across market environments. When markets move higher, growth-heavy sectors like technology and communication services pull the portfolio forward. When markets slow down, rising dividends and cash-rich balance sheets help stabilize the experience. That's what FITLX is built to do, let growth and income rise together. SCHD takes the opposite approach. SCHD is straightforward once you look at what it owns. It isn't trying to balance multiple goals, it's built with one clear priority: dependable income. Everything else is secondary, and that focus is intentional. Start with the sector mix. Roughly 55% of the portfolio sits in defensive, cash-generating sectors, which include energy at 18.9%, healthcare at 18.1%, and consumer defensive at 18.1%. These are industries known for stable demand and predictable earnings, not rapid expansion. Technology, by comparison, makes up only about 10% of the fund, which immediately tells you growth is not the priority. The holdings reinforce that idea. SCHD's top positions include Merck, Cisco, Amgen, AbbVie, Coca-Cola, PepsiCo, Chevron, and ConocoPhillips. These are mature businesses with established market positions and consistent free cash flow. They're not reinvesting every dollar to chase growth. They're built to return cash to shareholders. That design shows up directly in the income. SCHD's dividend yield sits around 3.75%, more than 3 times higher than FITLX. That means income is meaningful from day one, not something you wait decades to feel. Dividend growth is also strong, roughly 10.6%, and it's steady and predictable. This structure explains the trade-off. With fewer high-growth sectors and fewer reinvestment-heavy companies, SCHD naturally gives up some long-term price appreciation. Average share price growth has been closer to 7.8%, well below growth-oriented index funds. That's not a flaw, it's the cost of prioritizing income today. What you get in return is consistency. When markets fluctuate, dividends continue. When prices stall, cash flow doesn't disappear. For many investors, that visible income reduces emotional pressure and makes it easier to stay invested through uncertainty. Over time, this creates a very different experience from a balanced or growth-leaning fund. SCHD rewards you earlier through cash flow while accepting slower portfolio growth. FITLX delays gratification but compounds faster later. Both approaches work, but they solve different problems. FITLX uses growth to build income later. SCHD uses income to define the strategy from the start. In a few minutes, you'll see how the same $100,000 can grow into millions in 2 very different ways. one focused on total value and the other on monthly income over $28,000. On paper, that's a structural difference. In real life, it changes how investors experience risk. When people talk about risk, they usually point to charts, percentages, and market crashes. But for most investors, the real risk isn't what the market does, it's what they do in response to it. Volatility is uncomfortable because it creates doubt. When an account value swings up and down, it constantly asks you to make emotional decisions. Should you stay in? Should you adjust? Should you stop altogether? Even when the long-term math is sound, that emotional pressure can push people into bad timing. Income changes that experience. With an income-focused fund like SCHD, dividends continue even when prices don't cooperate. A yield near 3.8% means cash flow shows up regardless of short-term market moves. That visible income acts as confirmation that the strategy is working, which makes it easier for many investors to stay patient. Growth-oriented strategies require a different mindset. With FITLX, most of the return comes from price appreciation, especially early on. Income exists, but at around 1.1%. It doesn't soften drawdowns much in real time. For investors who are comfortable with uncertainty, that's fine. For others, it becomes exhausting. Neither response is a flaw. They're human reactions. The problem starts when someone chooses a strategy that doesn't match how they actually behave. A portfolio that looks perfect on paper can fall apart if it constantly tempts you to intervene. This is why behavior often matters more than expected returns. A strategy you can stick with usually beats a better strategy you abandon at the wrong time. Staying invested through downturns, continuing to reinvest, and avoiding emotional decisions compound results in ways no spreadsheet can fully capture. FITLX and SCHD work for different people. One asks you to tolerate more movement for long-term expansion, while the other reduces emotional friction by paying you along the way. Up to this point, we've talked about philosophy, behavior, and how these funds feel to own. But there's another layer that shapes long-term results, and it often gets overlooked because it isn't exciting: taxes and efficiency. Taxes don't change returns on paper, but they change how much of those returns actually get to compound. In a taxable account, dividends are usually taxed the year you receive them. With SCHD, a dividend yield of around 3.8% means a meaningful portion of returns shows up as taxable income every year. If you're paying even 20 to 25% in combined taxes, that's cash leaving the portfolio annually instead of compounding. FITLX behaves differently. With a dividend yield closer to 1.1%, far less of the return is taxed each year. Most of the growth comes from price appreciation, which is typically deferred until you sell. That gives compounding more room to work uninterrupted over long periods. Where this really starts to matter is in account type. In tax-advantaged accounts like IRAs or 401ks, this difference largely disappears. Dividends from SCHD can be reinvested without immediate tax drag, making income strategies far more efficient. In taxable accounts, the gap becomes more noticeable over decades. This doesn't make one fund better than the other. It means the same fund can produce very different outcomes depending on where it's being held. For this video, we're assuming the investment is held inside a tax-advantaged account like a traditional IRA or Roth IRA, where dividends can be reinvested without immediate tax impact. That levels the playing field and lets both FITLX and SCHD compound without annual tax drag. With taxes neutralized, the only thing left is performance over time. Now projections finally make sense, not as promises or guarantees, but as a way to visualize how each strategy can realistically compound when the same $100,000 is left alone. Let's start with FITLX. The starting dividend yield is about 1.1%, so income isn't the headline early on, but dividend growth around 15.42% changes the trajectory over time. Add average share price appreciation of roughly 13.38%, and you get a growth-driven engine with income acting as an accelerator rather than the main fuel. Based on these numbers, the projections show that a $100,000 investment in FITLX would be expected to grow to about $114,477 after 1 year. Over longer periods, the portfolio is projected to reach roughly $390,144 after 10 years, $1,558,441 after 20 years, and approximately $6,407,091 after 30 years. At that point, annual dividend income is projected to be around $109,840, which would translate to roughly $9,153 per month. Of the total $6,307,091 added over the original investment, about $5,574,945 would come from capital appreciation, while approximately $732,147 would come from reinvested dividends. Now compare that to SCHD. The starting dividend yield is much higher at around 3.82%, with the dividend growth rate of 10.61% and the average price appreciation closer to 7.82%. Income drives results much earlier. Based on these metrics, after 1 year, the portfolio is projected to reach $111,640, then $314,954 after 10 years, $1,120,352 after 20 years, and roughly $4,667,611 after 30 years. Annual dividends at that point are estimated at around $340,515, or about $28,376 per month. Of the $4,567,611 added, roughly $2,377,866 comes from capital appreciation, and $2,189,745 from dividend reinvestment. When you line the projections up, the difference becomes clear. Over 30 years, FITLX is projected to reach about $6.4 million, while SCHD is projected to reach about $4.67 million. That means FITLX produces roughly $1.7 million more in total portfolio value over the same time period. But income tells the opposite story. After 30 years, SCHD is projected to generate about $28,376 per month in dividends, compared to roughly $9,153 per month from FITLX. That's about $19,200 more per month in income from SCHD, or over $230,000 more per year. So the trade-off is clear in real numbers. FITLX is projected to give you significantly more net worth. SCHD is projected to give you significantly more cash flow. So if your priority is maximum portfolio value, the winner is FITLX. If your priority is maximum income, the winner is SCHD. These numbers are incredible, no doubt, but not everyone has $100,000 to start with. There's actually an even easier way to reach a reasonable goal. Click the video on the screen to find out how to make $7,000 per month with only $20 a week.